date. I think that would have surprised people at the end of January when the markets were down about 6%. And in just the past month, we've had a rally of over 8%. Now, it's not entirely clear if this is because investor positioning was off, if maybe the market was digesting a soft patch. But I think what's more important is it's a reminder that when we're in a bull market, and we believe we have been for the past few years, it's important to try to not time this market. That it's better to stay involved and to buy those dips. And that's been our advice for the past few years. Now, we still continue to be pretty bullish, and we think we're going to end the year up double digits. So we're looking for 2075 in the S&P 500, and really for that to be led by cyclicals, including technology, but also highlighting financials and healthcare. But that's not going to be helpful, because at the moment I think investors are struggling to find ideas, and we want to emphasize that there are some styles to look at. That is, if you're looking for ideas, what's actually been working and what things may look expensive and may start to not work. Well, let's take a look at this first chart and see what's been working year to date. Now, we're not talking about sectors here. We're talking about cutting the market up into quarters and looking at different types of segments of the market. And as you can see here, the market's really focused on growth this year and a momentum. Those have been the best performing styles. Now, the reason that this is happening in our view is this reflecting a quality bias, that investors got very cautious about growth, wanted to de-risk, so they focused on growth because growth outperforms whenever growth is scarce. And again, momentum works when investors are pretty scared about sort of broadening the market. Now, we think this is going to reverse. Why do we think this is going to reverse? We think it has to do with valuations, and especially relative valuations. So take a look at this chart. This is looking at what we call the Z-score, or how many standard deviations differential one style is from the opposite of the same style. And as you can see, there's three things that really seem to be pretty cheap. It's high free cash yield over dividend yield. We like that. It makes a lot of sense to us because you're buying, when you buy high free cash yield, you're basically paying 13.5 times earnings. It's also low price stocks, which continue to be curiously cheap. And it's also looking at momentum laggards or low momentum stocks. And we think that also makes sense. As you think about how the next 9 months unfold, we actually think the market's going to broaden, economic growth is going to pick up. You want to buy the momentum laggards. You want to buy the high free cash yield. You want to buy the low price stocks because these reflect factors people avoided early this year, because of a quality bias. We think that quality bias is going to go away. So to summarize, stay long. I mean, we like the word constructive, but I think it's not as clear. We want you to stay bullish. Focus on the cyclical stocks. Don't worry about the new price levels. I think that's just a sign of a breakout, not of a sign of a top. And to summarize, thanks for watching. This is